Chapter 18, Part 1, Shareholders' Equity, and we're going to talk today about issuing stock. So, what is paid-in capital? It consists primarily of amounts invested by shareholders when they purchase the shares of stock, and they arise from the company buying back some of those shares, and from share-based compensation activities. So, that's what it is. Retained earnings is earnings accumulated on behalf of the shareholders and reported as a single amount. This is what they earn based on selling products. Treasury stock, shares previously sold to shareholders that are bought back by the corporation. Accumulated other comprehensive income. These are all transactions that bypass the income statement. Now let's go back to paid-in capital. Paid-in capital. If more than one class of shares is authorized by the articles of incorporation, the specific rights of each must be stated. Common stock, normally that's what most companies have. It's easy because with common stock it doesn't have a stated dividend, so they can pay dividends or not pay them, because when a company starts, most of the profit for the investor is from the growth of the stock, not paying of dividends. Preferred stock has priority over common and has a stated dividend. These are usually bought by institutions. Now, there is some issue about preferred stock because it has a specific dividend, there's been some debate of whether preferred stock is debt or equity. Now, under U.S. GAAP, preferred stock normally is reported as equity, but is reported as debt when the dividends reported in the income statement as interest expense if it is mandatorily redeemable. Now, under the international standard, most non-mandatory redeemable preferred stock is reported as debt, as well as some preference shares that aren't redeemable. So, under the international standard, that's what the IFRS is, they treat preferred stock as debt because of the dividend issue. Now, retained earnings. Earnings accumulated on behalf of the shareholders and not yet distributed as dividends. Treasury stock, shares previously sold. Now, treasury stock used to be, there was no journal, no recording anything. You just adjusted the par value and the number of shares, but that's changed. So, now we have a revised business model, eliminated the concept of treasury stock, par value, and legal capital. Most companies are instead treating them as retired and then reissuing. So you won't see a line item called treasury stock anymore because they just retire them, and then when they want them again, like if they have stock options for their employees, they just reissue them. Now, accumulated other comprehensive income, what's that made up of? Well, net holding gains or losses on available for sale investments in debt securities, gain or losses from and amendments to post-retirement benefits, deferred gains or losses on derivatives, and adjustments from foreign currency translation. Now, under the international standard, they have a fifth one, and the fifth one is when they adjust their fixed assets to fair market value, which we don't do, but they do, and we've decided we're not doing it. Now, the concept of par value. Most shares continue to bear arbitrarily designated par amounts. Shares with nominal par amounts become common to dodge elaborate statutory rules pertaining to par value shares. One of them was that when a company issued stock, they had to retain in cash the par value of the shares to cover their debts. So then, of course, what corporations did is they set the par value as like penny or half a penny. Now, like the designations of common and preferred shares, the concept of par value and legal capital have been eliminated entirely from the Model Business Corporate Act. However, if you look at a lot of companies' financial statements, you'll see they still show par value. Now, let's take a look at a bunch of examples. This is the same company. We're going to go through all these transactions to help you understand it. Now, a company is started in 2021 with authorizes 5 million common shares with $1 par, 500,000 preferred with a $100 par. What are the journal entries? Well, authorize is the maximum number of shares that can be issued. issued, shares issued to the public, outstanding is issued minus treasury stock. So let's take a look at our journals. March 1st issued 500 shares of common stock for $20 when the market was $20 per share. The rule: although new companies are not indicating par value, in this example they have, so we must book common stock at par value. So it's going to be cash, which is the number of shares times the fair value. The common stock is going to be the number of shares times the par, and the plug is the paid-in capital excess of par. Now our next transaction in March. We issued 100 shares of common stock with a fair value of $20 and 5,000 shares of preferred stock for $2,550,000. Now, the rule is, if only one security value is known, the second security's market value is inferred from the total selling price. So what does that mean? You back out, you take the total amount, you first figure out, in this case, what the value of the common stock, which is $20 a share, and then you apply the difference to the preferred stock. So, cash is 2.55. Common stock is going to be 100,000 shares times $1. Paid-in capital is going to be the $20 minus the 1 times 100,000. The preferred stock is going to be 5,000 times 100, and then the plug is going to be additional paid-in capital, par, for the preferred stock. See how that works? So you use what you know, and then you apply the difference. Now, on March 3rd, we issued 5,000 shares of common stock in exchange for legal services. Now, we use the fair value of the stock because on the previous day we sold the common stock at $20 per share. So it is reasonable to assume that is the fair value. So the legal costs are going to be 5,000 shares at $20 a share. Common stock will be 5,000, which is 5,000 shares times $1, and the difference goes to paid-in capital. Now, on March 10th, we issued 200,000 shares of common stock in exchange for a building with a known value of 5.3. The rule: whichever evidence of fair value seems more clearly evident should be used. So the value of the building is known, so we would use that. So the building would be 5.3. The common stock would be 200,000 shares times $1, and the difference would go to paid-in capital. That concludes Part 1 for this chapter.